Okay, it is just after 7 o'clock, so we're going to go ahead and get started. Welcome everyone to tonight's presentation. We've got a lot of people RSVP to tonight's presentation, and a lot of them were familiar folks. So for those who have been on our webinars before, welcome back. And for those of you who are new or haven't been to our onto our webinars before, welcome. Tonight we're going to be talking about how much your pension is worth. Um, and before we get started, a little bit of background about myself and our company. My name is John Mantilla. I'm the co-founder and CEO here at Parco. And at Parco, it stands for Pensioned Americans Retirement Company. And we help federal employees across the country and around the world plan their retirements and their finances no matter what stage of their career that they're in, whether they're just starting out their career, whether they're mid-career, or more and more folks planning their exit from federal service and wanting to make sure that they're in the best position for the future. And we've presented in a lot of different places to audiences big and small, all around the world, and we've been featured in a lot of cool publications. So that's a little bit of background about us. And so tonight we're going to be talking about your federal pension. And one of the things that we say a lot here at Parco is that federal employees are different. And so tonight we're going to be talking about your pension, which is perhaps one of the most unique benefits that you have as federal employees. So we're going to first talk about how pensions are undervalued. We'll talk about what a pension actually is. We'll talk about the FERS and special FERS pension formulas to figure out how your pensions are calculated. We'll talk about then what it's worth. Like what would it cost to recreate a pension in the private market if you were a private sector employee? We'll talk about some unique aspects of your federal pension. We'll talk about some other hidden values, and we'll talk about how to get started as we wrap up with an example. So, a couple things as well. There is a chat and a Q&A window. Feel free to post any questions or things that you have in there, and afterwards during Q&A, I'll answer every question that comes through that. All right, let's go ahead and get started. Let's first start by talking about how pensions are undervalued. So, and I'm sure many of you have experienced this, but when you think about the visible benefits or the visible assets that you have, you might have a TSP, you might have your home, you might have an IRA or an advisory account, you might have savings accounts, you might have physical stuff. Also, things like a mortgage or a student loan on the other side of your balance sheet. These are things that you can see that are benefits that are available to you, or that are assets that are available to you. That you can look at, you can monitor the value of them and how they change over time. Well, there's other things that you have, like your Social Security statement or your Social Security benefit, which, while it's not a lump sum, is still a benefit available to you. And the government is pretty communicative about how much that benefit will be when you turn it on at a certain point in time. So we always like to kind of call those like visible benefits, like things that you can see, visible assets, things that you can touch. But something like your pension um, isn't one of those things that you're thinking about all the time, right? It's very much an asset that you have. It's something that you'll have when you retire, but it doesn't show up on any of your balance sheets. It doesn't show up on any of your statements, really. So you don't really think about it. And especially for federal workers and government employees, I think a lot of folks that we work with are always surprised at how uncommon and indeed how rare pensions are. Just 18% of Americans right now, and it's a declining number, have pensions. In the private sector, they've basically entirely disappeared. So, like your friends that work for private sector companies, very few, if any of them, have pensions now. And if they do, they might be part of a legacy system because they've been there for a long time. But new employees, new hires, none of them are getting any sort of like pension situation or pension schemes. The exception is with governments. So federal government, state, local government, teachers, folks like that, those folks still have pensions. And government's really the only type of service that you can get into, the only type of career you can get into where you have these pensions. So something that even 20 years ago, but certainly 60, 70 years ago, was way more common among the populace has become very, very uncommon. It's not something that most people are used to. And so, what exactly is a pension? Well, it provides a lifetime income stream to you in retirement paid to you by your former employer. It can be pension, it can be inflation adjusted depending on who your employer is. You can also leave a survivor benefit if you if you want to, but it's basically a lifetime income stream paid to you by your former employer for the rest of your life once you've separated from service. It's very much, and a lot of people even call this, basically an annuity, right? It's an annuity payment. In fact, like the original annuities that were developed were uh, were lifetime income streams for Roman soldiers. So these are one of the oldest forms of retirement benefits that exist. In fact, like they're kind of like the fundamental retirement benefit that's offered by institutions. And one of the reasons why they're so powerful is that in retirement, more Americans are worried about running out of money than they are about what happens to themselves when they pass away. Like the number one concern that people have about retirement is running out of money. And the powerful thing about a pension is and always was that it provided you an extra lifetime income stream on top of anything else you've saved, on top of Social Security in retirement to try to, help you make that retirement easier. And I imagine for a lot of you, part of the reason why you decided to work for the federal government was that, sure, maybe you could have made more in salary in the private sector, but this pension benefit was going to make your retirement a lot easier. And we see that play out. And we see that a lot every day here at Parco is that federal employees are able to consider retiring a lot younger than most Americans because they have a benefit like the pension. So when it comes to your FERS pension, or for those of you who are special FERS or LEO, it's calculated pretty simple. They take 1% times your creditable years of service times your high three. Now, you do get credit for every whole month of service that you do, but this is a good, easy way to think about it. So if you had 30 years with the government and you're 58 years old at the time that you retire, you're going to get 30 times 1%. So 30% of your high three, which is your highest three consecutive years of service, paid to you when you retire for the rest of your life. If you stay past age 62 and you have more than 20 years of service, they increase this amount by 10%. So this is the formula for the FER pension. For special FERS or for LEO or for firefighters or folks like that, the pension's a little bit more generous because those folks have a more hazardous job. So the LEO pensions are a little bit more generous than the normal FERS pensions. But they work the same in that they pay out a lifetime income stream for you in retirement once you separated from service from the government. They also have some other attributes. For FERS employees, you guys get a COLA or a cost of living adjustment like you do on your salary. You get those starting at age 62 on your pension. That's really valuable. The fact that you get some sort of inflation protection in your pension once you turn age 62 is very, very valuable because you think about how cost of living increases over time. For those that are LEO or for special FERS employees, that COLA actually starts right at retirement. And importantly, with your pension, you can also leave a survivor benefit. This allows you to leave a portion of your pension to your surviving spouse if you pass away. And for FERS employees, when you're deciding what you want to leave behind as a pension, or if you want to leave behind any of your pension, you can elect one of three options. You can elect no survivor benefit, so your pension's not reduced, but if you pass away, your spouse is entitled to nothing. If you elect a partial survivor benefit, your pension's reduced by 5%, but your spouse is entitled to a quarter of your pension for the rest of their life. Or you can elect a 10% survivor benefit in exchange for a 10% reduction in your pension. Your spouse is entitled to half. Usually, again, this is another way that federal employees are different because you all get to keep your federal health care in retirement. Um, if you want to make sure that your spouse always has access to that federal health care, even if you're gone, you want to at least elect a partial survivor benefit. And so when you think about how that could affect your pension, let's say that you had a $50,000 a year pension, that partial survivor benefit would cost you about 5% of your pension or $2,500 a year. Or if you elected the full, it'd be $5,000 a year. But your spouse would be entitled to a good extra income stream if you did pass away. Everybody tracking so far? So, getting back to like kind of what we talked about tonight with what what's this pension worth? You have this monthly income stream that you're going to get in. What's it actually worth? Because I think that, you know, our team here speaks with thousands of federal employees. And one of the things that comes up a lot in those conversations is, sometimes we'll talk to people and they're like, man, like I can't think about retirement. My neighbor down the street was telling me he's saved so much money in his 401k. I don't have nearly that much. Like I'm way behind everybody that I know. And we say, well, look, for private sector folks, for most Americans, when it comes to retirement, they have two benefits. They have Social Security and they have their 401k, which is whatever they've saved on their own. Maybe their employer matches their or maybe their employer matches their 401k. Many don't. But that's all they're going to have to be able to sustain their lifestyle throughout their entire retirement. It's why so many of the folks that you might know, or your peers or private sector folks, retire maybe a lot later than you're thinking about. They might wait till 67, 68, 69, 70 because they have to live on these two assets primarily for the rest of their lives. Well, as federal employees, you have those two assets, sure. But then you also have your federal pension. And those federal pensions are worth a lot, even though they don't show up in your balance sheet. So it can also really enable you, because of that, to retire. So let's take a look at a quick example. And I think I'm going to actually kind of poll the audience here to ask people to put in their guess in the chat. But how much is your federal pension actually worth? So let's take an example of Fox Mulder, FBI. Okay, so he is retiring. He's going to be 60 when he retires. His high three is $100,000, and he's regular FERS when he separated. He didn't stay as a special agent. So he's regular FERS. His pension is going to be $30,000 a year or $2,500. How much is that $2,500 a month worth for a 60-year-old man? Well, and I'd encourage all of you because we can actually answer this question with precision because we can look in the market for that number. Um, so I'd be curious to know if in the chat what you all guess that's worth. Is it worth $200,000? Is it worth $300,000? What do you think that pension's worth? I'm going to wait a second just to see what guesses come through. $1 million, 600. So there's a few guesses here. $1 million, 600 to $750,000. I'll let a few more guesses come through. Thank you for those that participation, everybody. So for us to get that number, $800,000. You all are pretty good. So for us to get that number, we basically say, well, look, what would a $2,500 annuity cost that also has a cost of living interest? And there's companies that offer those, right? So we can just go into the private market and say, hey, look, what would it cost to get something as close to this as possible? And the answer for a 60-year-old man in the state of Virginia was just over $700,000. So in Fox's case, that pension as a 60-year-old man is worth over $700,000. Now, that doesn't show up on his balance sheet. That doesn't show up anywhere in his financial statements, but that's very much like economically what that's worth for him. Great guesses, everybody. So for a 60-year-old man, here's a breakdown of what the market says those are worth right now. Right. And this fluctuates, right? When interest rates change or as longevity changes or as actuarial tables change, at Parco, we can actually value these like every single day. But if your pension was, let's say, $1,000 a month, and you're like, no, like it's just $1,000 a month. Well, that's like having an extra $256,000 in your 401k. If you have a bigger pension than that, it's obviously even more. So hopefully, like right now, that's starting to, for some of you, it's trickling in your brain. You're like, hey, look, I'm actually in a lot better shape than I think. It's why sometimes in the past we've said at Parker, like our clients are actually like a lot better off and a lot more wealthy than they look because they have a lot of these hidden assets. And so, what else does the federal pension unlock, right? Like being fully eligible to retire means yes, you get an immediate unreduced pension, but it also means a few other things too. As a federal retiree, you get to keep your federal health benefits in retirement. That's amazing, right? Like for the second thing that people are worried about more in retirement than just like after income, it's what am I going to do about healthcare in retirement? We've done webinars on this in the past. We'll do more in the future. But the fact that you get to keep your FEHB in retirement is a really big deal. You also get to keep your vision and dental if you want to. You can keep your federal long-term care if you're enrolled in that. You get to keep your FEGLI in retirement. And we haven't really talked about it much, but for those of you who retire before age 62, fully eligible from the federal government, you also get a first special supplement, which is basically like another payment to you, paid to you until you turn 62. All of these things unlock because you get a federal pension. So let's take a little case study about who can retire. So let's take again Fox Mulder. He's same situation, or like I said, Fox is now 2 years older. So he's 62, makes $100,000 a year, has 30 years of service, and his TSP balance is $250,000. Same guy, Michael Scott, works in the private sector, makes the same amount of money as Fox, but has saved 3 times as much. So the question is, who can think about retiring? Well, it would probably surprise some of you, but the guy that saved 3 times as much is actually not in as good a shape as the guy that's only saved $250,000. And it's because of his Fed pension. So let's look at like some of the simple numbers here. They both have the same Social Security amount, right? They both have the same salary. And they both have the same income goal of making about 65% net of what they're used to living. So Social Security is 2320. The pension is going to be 2400 for Fox. Michael Scott doesn't have that. So when we look at their totals from just their pension or Social Security for Fox, it's over $4,700, whereas for Michael Scott it's just 2320. So that gap is just over $1,100 for Fox, but it's over $3,500 for Michael. And so when we look and say, okay, how much would it take to bridge that gap? Well, Fox has enough to bridge that gap, whereas Michael Scott would have to devote more than the amount that he has saved to bridge that gap. And we haven't even talked about this. Michael Scott's going to figure out what he's going to do about his health care when he separates from his job because he doesn't get to keep his health care in retirement. Federal employees and federal retirees do. So your pension's worth a heck of a lot more. And it's what enables federal employees to retire longer and retire, importantly, a lot younger. And one of the things that I think is really exciting for us at Parco, truly, like, of course, we love helping people with their money and helping them plan out their FEGLI and help them plan out, military buybacks and all that stuff. But what's really special about federal workers when it comes to retirement is that you can retire a lot younger than you think. And what that means is that can enable you to have a lot more years. Uh, you can have a lot more years with your spouse or with your family than you otherwise would. I've gotten some feedback that people are having trouble seeing my screen. Is that still the case? Is anybody having trouble seeing anybody else having trouble seeing my slides? Okay. Okay, thank you. If anybody's having trouble though, and we also are going to make a recording of this available. So if you can't see it, let us know. So, we've gone through like what your federal pension's worth, but when you're thinking about how to get started, how to think about this stuff, there's a couple things that we would say is sort of like your checklist. First, determine when you're first fully eligible to retire. That's when uh, that's when that value really starts, right? If you're 40 years old and you're planning to work for another 20 years, figure out what your pension will look like. And that's something Parco can help you with when you turn 60 or when you become fully eligible. So we can at least know what that number is. Then calculate your pension, what it'll look like at full eligibility. Importantly, too, evaluate your income goals in retirement. How do you want to live in retirement? Factor your pension into your retirement income plan and see how much you're going to work for when you become retirement eligible. I tell this story a bunch. We were working with a postmaster out of the Midwest, and she spoke to us, and she was 64 years old, and she had planned to work another 3 years. And we asked her why, and she says, "Oh, well, that's when my Social Security is at full Social Security age. That's going to be the best age for me." Well, we ran the math, and her Social Security, if she took it when she was 64, plus her pension, meant that she would actually have more income coming in that scenario than she had while working for the post office. So, in a very real sense, she was paying to go to work. So, she retired a lot sooner than she had planned because she did this type of analysis. And that could be you or somebody that you work with. And it's one of the things that we help folks plan for every single day. And so, I know a lot of you have already created your free Parco retirement platform accounts. We encourage all of you to do the same. So I know this is kind of like a novel way of looking at federal pensions. I know this topic's pretty cool, uh, but we think it's really important because we know that folks get, they can get down on themselves saying, "Oh, I've got this Fed pension," or "Oh, I haven't, I started in TSP late. I wanted to start earlier." A lot of you are in a lot better shape than you think. So with that, I'll open things up to questions. As always, it's a pleasure to present to you all. Hopefully, you found this topic interesting. I think it's a unique way of looking at perhaps the most powerful benefit that you have as federal workers. Yeah, and if you do have any questions or points of clarification, just ask those right here in the Q&A in the chat. Okay, yeah. So there's a question about a deferred retirement. So if you do a deferred retirement, they can take two different flavors. Um, so let's say that you retire at age, or you leave federal service at age, let's say age 60, and you have 12 years of service. Most people would elect what's called an MRA plus 10 retirement, where they take an immediate pension, but it would be reduced because you didn't hit the normal eligibility requirements. You could do that. That's a normal MRA plus 10 retirement. It happens. You could also do what's called in that case, a postponed retirement, where you say, hey, look, I'm not going to get my pension. However, when I turn 62 and I would otherwise be fully eligible, I'll turn my pension on at that point in time. All your benefits get reinstated and your pension's unreduced at that point in time. We don't see a lot of people elect just because they'd rather get the immediate pension and the MRA plus 10, and or they'd rather they don't want to have the healthcare gap for 2 years. There's also a situation where folks, and this was particularly uh, common with the DRP last year. Well, as long as you have 5 years of service with the federal government, you are entitled to a pension in the future. And oftentimes, this is what people call a deferred retirement. Um, so let's say that you were hired with the government for at 30 years old, you worked for them for 7 years, and then you haven't worked for them again. Well, at age 62, you're owed a pension. That pension would be for those 7 years, 7% of your high three that you were making during your time with the federal government at that point in time. So you're owed a pension then. Starts at age 62 and you get paid that for the rest of your life. If you're thinking about a deferred retirement or you're thinking about a postponed retirement, make sure to talk to us because there are definitely breakpoints where it's like, hey, look, it makes sense to stay, or it makes sense to like get to a specific date where it doesn't affect you as much as it would have if you retire early. So, Paul, if that's something that you're interested in, that's something we could certainly chat about here over the next week or so. There's another question that says in FERS for the survivor benefit, is there a minimum age to get 50% of FERS if your wife is younger? There is not. So that's a great question. So we've seen some situations where a client's retiring and they're like, hey, should I get the survivor benefit? And there have been situations where it's like, well, look, my spouse is significantly older than me. Do I need to elect a survivor? And we'll say, well, look, like, the actuarial on it, you don't necessarily need to because the odds that they outlive you are pretty low. On the flip side, though, we do have a lot of where they say, "Hey, look, I'm significantly older than my spouse. Are there any restrictions or issues with me naming them as a survivor benefit or naming them as the beneficiary for my survivor benefit?" And we say no, and in fact, it's actually better for folks like that because if you are significantly older than your spouse, uh, the odds that you pass away before them are high, and so for them, they're going to be able to collect that benefit for a longer number of years. So, short answer or long answer to a short question: uh, there's no age checking. Uh, I've seen some pretty big gaps for folks on both ways. Um, so, um, in those situations, it definitely makes sense to elect that survivor. Jim asks, what's your opinion on Roth conversions of traditional IRAs, either TSP or financials like Schwab, Fidelity, and Vanguard? So we do, that's a great question. And actually, Jim, I think we're probably going to do a Roth conversion webinar. I'm going to write that one down, actually. We're probably going to do that one next for, if not next, that one is in the hole. Um, Roth conversion webinar. Um, because we're getting a lot of people asking us about that, and it's about the time of year where it's worth thinking about. So, what are our opinions on Roth conversions? We think they make a heck of a lot of sense. Now, 9 times out of 10, we don't think it makes sense for people to do a Roth conversion while they are working. And the reason why that's the case is that most of the time people are in a higher tax bracket while they're working than in retirement. Uh, so usually Roth conversions are a strategy you do in retirement. And with that said, the process that we have at Parco, and what's nice about being a federal employee is that most of y'all's federal or most of your incomes are going to have a floor in retirement, right? You're going to have your pension, like we just talked about tonight. You're going to have Social Security coming in. Maybe you're going to have some distributions that you're going to be living on from your 401ks or from your IRAs. So you've got a floor of income coming in no matter what. And you're probably going to have that floor for the rest of your life, right? Social Security pays out for your life, pension pays out for your life, any income payments that you want to help supplement your lifestyle from your retirement savings are probably going to persist for the rest of your life. So that makes the Roth conversion process really easy and straightforward because the math is you might as well convert up to the top of your bracket to get as much as possible into Roth uh, for the future. The reason why that's valuable, Jim, is that Roth conversions, Roths grow tax free forever, right? So you have access to that money tax free forever. So it's insulated from future tax increases. The Roth conversions are also really powerful for beneficiary planning because your beneficiaries don't have to pay taxes on Roth money. So if they inherit a Roth account, they don't have to pay taxes. If I inherit my dad's Roth IRA, which I hope I don't for 30 years, um, uh, or if I inherit my dad's traditional IRA, I will have to take the money out of that account within 10 years, and that money's going to count as taxable income for me. So uh, we think Roth conversions are really great. It's a core part of what we do on our financial planning and wealth management business is helping people plan those Roth conversions every single year. So again, another long answer to a short question. We think they make a lot of sense. And it's usually about whatever mechanism, wherever it's easiest for you to do them is the place to be. In your last example, can you clarify how she could retire early at 64 instead of 67? Yes. So Lester asked just about that client we worked with in the Midwest. So her name was Paula. Her name is Paul. She came to us and said, look, like when we sat down to our first meeting, she says, I'm planning to retire in 3 years when I'm 67. And she had 32 years of service at the time. She'd been working for the post office for a long time. And she'd been putting money into her 401k, into her TSP. She saved a lot, just single gal. And we looked at how much she was making while she was working, after all of her deductions. And that amount was, I'm making up a number here, $2,000 a pay period, or about $4,200. And then we looked at what her pension would be given her years of service and her age and her I3. And we looked at what her Social Security would be with her with her age. And we netted those two things together. And actually it was going to be like $4,700. So she was going to be getting, if she retired right now, she'd get $4,700 per month then. Keeping working for the post office was netting her $4,200. So by not going to work, her net income that she was taking home every month was actually going to go up. So that's why she was paying to go to work. Um, so Lester, did that make sense? That's how we did that math. Do bonuses and cash award get added to your salary for purposes of highest three calculation? I do not believe that they do. I think that there are a couple exceptions for that we've seen for some folks in like the foreign service. And Peter, I'm going to actually write that down as a question for our team. Um, so let me get an answer for you on that. But I do not believe that they do. Uh, I do not believe that they do. I'm going to send that into our team really quick and ask. So if you hang tight for just a second, I will be able to answer that question. I see another question coming in. Hold on. Oh, it's the same question. Y'all give me one moment. Peter, I'll try to get an answer for you. What did you all think of this topic so far? I mean, there's obviously like a lot that we can go into, and there's always so many different topics we can cover, and you never know how deep you want to go. Uh, but we always want to make these things valuable for you all. Um, so, you know, the suggestion for the Roth conversion webinar from Jim is really good. Um, oh, Peter, I just got confirmation from my team. Those do not count toward the high three. All right, well, I'll keep the channel open for just a few more minutes just to see if there's any other questions that come through. Um, no, I like the cool words. We won the lottery because we're born in the US of A, baby. And so there's a good question that came in the thread about like what's our business model. So, Parker, we do retirement and financial planning for anybody with a pension, but especially federal employees. And so we basically are that one-stop shop where we can help people plan their retirements. We can manage your money. We can do tax preparation. We can help with life insurance. We can help with income planning. We can even help people get a mortgage, basically all through our platform and then through our team. So we started the company because we were working with a lot of federal workers, and they're like, man, like I've got a guy that's helping me with my life insurance, and a gal that's trying to help me with my mortgage, and this guy's managing my money, and this shop over here is doing my taxes, and none of those folks worked with each other, right? They were all independent, and so we said, well, look, we'll put that all in one place. So depending on what service you use us for, is how we get paid. Um, So we're a full service uh, financial firm and financial planning platform. And just depending on the different services that you use, we that's how we get paid. That's our business model. Caroline, hopefully that answers your question, um, and yours too as well, She. Lester asks, is sick leave significant when added to the calculation of years of service? This is a great question. So we actually did a webinar on this a few weeks ago. And so sick leave will, any unused sick leave that you have, they do a calculation. They will add a portion of that sick leave to your time in service, which will increase your pension. Now, as federal workers, it is always more valuable to use your sick leave while you're working than to retire with it. It's way, way, way more valuable for you to use it while you're employed than to retire with it. Now, there are some folks that we were on the webinar with a few weeks ago, and I had one client that had 3,000 plus hours of sick leave. He's planning to retire at the end of the year. It's not practical for him to use all that sick leave before he retires. He actually can't. He's got a year and a half of sick leave. So there are some sick leave magic numbers, Lester, to try to hit. And our platform will actually do those calculations for you to say, hey, look, if you can't get to zero, try to get to this amount or to this amount. And that's right on the sick leave, the leave and benefits tab. Um, so you do get some credit for it on your pension, but if you have the ability to use it before you retire, do so. Way more valuable to use it. That's what it's for. Um, and Shaheen, yeah, you echoed that same point. And then, do we recommend transferring out of TSP after separation? That's always client dependent. So some folks say, "Hey, look, I want to stay at the TSP because I've been with it for a long time." A lot of folks now are electing to move their money outside the TSP because they want to have more flexibility with their investment options, or they want to work with an advisor, or they want to be able to choose their tax withholdings, or have more visibility into how they do their Roth conversions. So it's always client dependent for us. We always start with Parker was like, what is your goal? And then we see what your situation is, and then our job is to figure out how to help you achieve that goal as efficiently as possible, as best as possible, as fiduciary as possible. So Shaheen, hopefully that answers your question. Thank you. Well, look, this was a great topic. You guys are a great audience. It's always fun to present to an audience of this size. Every week, it seems like they're getting bigger and bigger, and we know this was a really popular topic. So I'd encourage everyone tonight, create if you haven't already, create your free account on our platform. Give us feedback. We'd love to hear if there's something we think you think we're doing good, but importantly too, if there's anything you think we could be doing better that'd be more useful for you, please let us know. We built the platform and our whole business to work with federal employees and to help them get this information because we know it's hard to do so. Um, I'm always motivated by the fact that I know there's somebody out there tonight who would be better off if they just knew something that we were able to share with them. So, and that's why we built the platform to work with as many folks as we could. So, Sydney asked another question: how do you get paid compared to other organizations to offer the same services? I don't know all the details of other business models and how they work. I know that our uh, like for our wealth management business, everybody's always trying to tell us to raise our fees, and we're like, we're not raising our fees. But we always try to recommend the stuff that's going to be as low cost to our clients as possible. And one of the benefits about having technology and working with a specific group of people is that we can offer. Um, our whole thing is to have the best reputation in the business, and you do that by putting the client first, not by putting yourself first. So it's a good question. So all of our, for wealth management, which is, I think, probably what you're asking about, we just charge a percentage of assets fee. Uh, for things like tax preparation, things like that, that's a flat fee. Um, life insurance and things like that, that's usually based off of how much life insurance you need. Uh, so it's all very standard, but we're also at the low end in terms of the costs. Um, and like for things like life insurance, the carriers pay us. Great question, Sydney. Does that make sense? I know you all can't raise your hands, but and we don't offer any fixed fee or one-off or like by the hour financial planning, but all of our retirement consultations and independent individual consultations are free. So you're a one-on-one with us to do to go through your retirements and everything like that. That's totally free. Okay. You've been with the government for 16 years, but I don't know that I have the pension you talked about. Okay. Well, Sydney, why don't you, if you want to stay on here, you can actually set an appointment with one of our teammates right from the platform. Or if you'd like, I can have one of our teammates give you a call right after this meeting, right after this webinar, and we'll get a time on the calendar to kind of go through your situation and see what's going on there. Because if you've worked for the federal government for 16 years, you're definitely owed a pension, unless there's something that's going on with your case that I don't know. Does that sound good? Okay, cool. I'll have Lauren, our teammate, reach out to you here as soon as we wrap up tonight. Great question. Where are we based out? We're I'm based out of Richmond, Virginia. We have teammates in St. Louis, but we work with federal employees across the country and actually around the world. 'Cause we work with a lot of folks in the foreign service, and we do all of our meetings virtually. So on Zoom or on Google Meets, or for those of you who need Teams, uh, we do all of our meetings just like this. Well, individually, not in a big group setting. Um, we're about 90 miles south of DC. We go up to DC, I'd say um, at least every 6 weeks for different presentations that we have up there. How did DRP impact your business last spring? Well, I was in the middle of we were busy. We were busy, and we've continued to be busy since then. Um, there are a lot of people that retired under the DRP. I think it was actually a little bit less than some people expected. It certainly shifted it hastened people's retirements. Um, what I would say is has really impacted things is that more federal employees are thinking about retirement now than ever because the president was talking about federal employee retirements in the Oval Office on the news for like 2 straight weeks. So it certainly shifted the Overton window on that pretty dramatically. So we've been really busy. It's part of why we've been investing so much in technology to make it easy for you all to understand, you know, how on track you are or what things you need to do if you're a federal employee to put yourself in the best position for retirement, whether it's next year or next month or tomorrow. Uh, uh, so cool. Well, Sydney, we're going to reach out to you here this evening. If there's anything that you need all in the meantime, please let us know. As always, it's a pleasure to present to you all. We'll be doing an encore presentation of this presentation next week, same time, same place. Uh, Probably with a few more developed slides just based on the questions uh, 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 you guys all asked. And then thank you for that suggestion, Jim. I think we're going to do a Roth conversion one after that. So be well, everybody. Have a great night. Stay cool. Hopefully things are cooling down for most of the country here. And we'll see you all next week. Be well.